Hi, everybody, and welcome to this week's Middle Class Investor. Coming to you a little later than normal on Monday, about 10 minutes after 11. And just had some family in from out of town and couldn't get to it this weekend. But coming to you now. So, as usual, we'll start off with the S&P 500. And as you can see, we had kind of a flat week. Last week. This is last week right here, not this one, because we're starting here on Monday, so this is the first day of the next week. But the actual week we're looking at is this one right here. So potentially an inside week, although we gapped up pretty high here. It's hard to see on this particular view, but kind of had a little pennant here, and then we poked up out of it. But let's zoom in and look. Well, first of all, let me show you something that I think is important. Let me back up and do it like this. Oh no, I'm not gonna be able to get to it. But anyway, you can see. I'll do it in two different segments, but you can see here how this is. It's been going up for weeks and weeks and weeks, right? You can clearly see that that's up. But what I want to show you is, while that was going up, you can see it's up here. This is looking like a divergence. In fact, it's starting to roll over a little bit, which could be a potential divergence in the market. So the whole time the momentum is going down, the market was going up. And we call this a divergence. And we've been talking about this actually for a while. It's just back here, back in these weeks here, it hadn't started to curl over yet. And you can see it's starting to curl over now. So likely through going up. But these divergences happen when other things happen, like advanced declines start to turn negative and things like that. So we've been talking about that for a while. The advanced decline line has been going down for a while, at least for the last 10 weeks. And so you could see this potential market divergence happening. And really what that advanced decline line just means, it just means fewer and fewer stocks are causing the market to go up. And so I forgot what the statistics are, but something like 5 stocks have literally caused this market to go up since June of last year or something like that. So it's a significant. June of this year. So it's it's a significant narrowing of the market. And when you get that kind of narrowing over time, the market just starts to fall under its own weight. There's just not enough supporting it. So potentially that's what's happening. I don't know for sure. There's no way to really know, but you can definitely see a market divergence happening. You can see the peak was back here, but we've made new highs. Now the market's made new highs, but the internal measures, the internal momentum has not made new highs. In fact, it's starting to curl over here at where it's located now. So, all right, let's look at the volatility index. I mean, volatility is still very low, historically speaking, and even the internal momentum for volatility is very low. Now, normally you just look for momentum to confirm, kind of what the market's doing. So if the market's up, you see volatility go down. If the market's down, volatility typically goes up. And sometimes you can find divergences in here, but it's a lot harder to find. But volatility is an important thing to watch, because as you can see here, we had this downtrend line, and it lasted a long time. But once it broke out of it, I mean, you can see volatility expanded very rapidly. And these are times when there's a lot of fear in the market, a lot of imbalance, and positions, and traders are repositioning their accounts, and there's just a lot of fear and stuff like that. So when volatility is low, especially for a long period of time like it was here through most of 2017, you just want to kind of be on the lookout. Obviously this is a lot of time here compared to this amount of time here, but you can see the volatility is kind of right back here. So it could be that it broke out, it's pulling back to the trend line or thereabouts, and then it's going to break out again. We'll just have to wait and see. Let's look at the 10-year yield. The bonds, we were kind of waiting for this to pull back here into this decision point area. It may or may not still. Typically, if the market starts to sell off, some money, and at least initially will flow into bonds, which could drive this yield down even lower than where it is right now. It could drive it down here closer to 2.5%. And I think that's a likely outcome if this market divergence continues to play out in the S&P 500, and we actually get a sell-off in the S&P 500. Let's look at the 13-week Treasury. Of course, the Fed, raised rates again last week, and we pretty much said that was going to continue to happen until this substantially starts making lower highs and lower lows. The Fed's going to keep raising rates. So I think we've discussed on here many times that the Fed doesn't set rates. It follows rates. It only sets one rate, and it's only a suggestion. It's the suggestion rate. That's what they really ought to call it, that banks use to lend to themselves. So if Wells Fargo wants to borrow money from Chase, they use the Fed funds rate. Okay, and then even then they don't have to. They just that's just a suggestion by the Fed. So the Fed really has. I know there's a lot of saying "don't fight the Fed" and these types of sayings, but the Fed's control over rates is really more of a perception now, unless they're doing something like quantitative easing, like they were back in 2013 and 14. Quantitative easing is actually something they absolutely can do to lower rates, and because what they're doing is they're actually buying bonds. So when they buy bonds, they drive up the price for bonds, and when you drive up the price for bonds, that lowers the yield. So quantitative easing is something that the Fed can do to actually lower rates. But that is so unprecedented. Just historically, the Fed has not done that, and so therefore the whole idea that the Fed controls interest rates is just not a factual truth. All right, moving along. Let's look at Germany. See, we're still kind of stuck in this little channel, downtrend channel. A lot of times channeling like this, unless you get a breakout to the downside through the channel, this channel is likely a counter trend move, meaning Germany is likely to break out and go this way. We'll just have to see. Obviously, if it's sold off really hard down through the lower bound on this channel, like if Germany in the coming weeks sells off hard and breaks this lower bound of the channel, then we would turn and say this is not corrective, and we're no longer looking for an up move. We're looking for a continuation of a down move. But that hasn't happened yet, so we'll just have to wait and see what's going to happen there with Germany. Japan looks like you can kind of see that it's kind of already broken out of its down move. This just could be the wave A of its first move down. This is quite a bit of time back here, so this is not a very large correction. We would expect to see something a little bit larger. So you might see Japan, kind of pull back and then bounce again, and then maybe go lower. maybe somewhere down into this 45 area. Kind of like this one, you can see how it made a move down and then made a lower high and then a lower low. Now this is very corrective looking, so I would say the United Kingdom is poised to continue higher in the direction like it's headed now. Maybe it pulls back a little deeper and then starts to rally, like this, and maybe even break out of this channel to the upside. It's interesting. Whoops. It's interesting because the whole world is so negative on Great Britain with this Brexit. Like Brexit's going to be, the demise of Great Britain. Of course, one of the reasons the British people are pursuing this Brexit is because the European Union has done just ridiculous things to them, like tell them that they can't fish their own, they can't fish the North Sea. A bunch of fishermen have gone out of business, and what they've done is let Norwegian companies come in, or companies that don't border their area literally come in and fish the waters right off the coast of Great Britain, and somehow it's illegal for Great Britain to fish those waters. I mean, it's crazy stuff like that. And then there's just no representation. So there's no sovereignty of the people and things like that. So the people aren't liking all these, this cultural influx from Middle Eastern countries and things like that. And they're being told by European Union they've got to take so many from Syria and so many from Iraq and so many from Iran and all this kind of crazy stuff, and they just have no say, and they're tired of it, so they're leaving. But because the establishment class is trying to consolidate power on a worldwide scale, they're bad mouthing and saying it's going to go bad and all this other stuff. I think it's mostly just chatter. I think Great Britain's going to be doing fine. I mean, they've existed for a long time. I think they'll continue to exist with or without the European Union. So just a little political note there. Let's see what else we have. The Russell 2000 is kind of interesting because it appears that its move is over. You can kind of see, let's zoom in. I want to zoom in just on this last part right here. Well, you can't really see it. Let me try it with this. Yeah, so, we always talk about once you have 5 waves, you're going to get some sort of correction. So you can see here we got 1, 2, 3 up into here somewhere, 4 and 5. So, and of course this is part of a larger 5-wave move where this is 4 right here, and this whole thing is 5. So this was 3, 3 up to there, and 3 probably runs all the way back down here somewhere. So you got the Russell looks like it's completing a very very large degree. This is a larger degree 4 right here, and likely Russell, you're going to see the Russell pull all the way back here to this 900 area. So I don't know what that is. Let's just see what kind of correction that is. It's not insignificant. So let's say it pulls back into this area. That's what was that? That is minus 50%. So that's pretty substantial pullback in the Russell, likely in the Russell. So keep your eye out for that. And that may just be A. That may just be A in the move. I'm going to show you some charts here in a minute from Elliott Wave and from Deneric, and I think they've got they've got some good charts to give you some context. Let's switch over to toss charts right now, though, and look at well, let's look at gold real quick. So this was the run up, you know, into 2011 highs with gold. And of course, what we're experiencing is some sort of correction, and this is likely the A wave of the correction right here. And then we're likely experiencing, you know, some sort of B here that, you know, will probably take us up, could take us up as high as 1500. And then we'll see a C, and that'll be the end of the big commodity boom in gold, oil, coal. I mean, just all the commodities in general. Silver is looking a little bit different. It doesn't look, I mean, gold looks like it could still make another leg down. Silver looks like it's finished. I mean, it looks like it's rallying here off the bottom. It's got a higher high, a higher low. And it looks like it might be finished. And as far as how high will it go? Well, you know, I'd look for silver to probably close this gap way back here and go as high as $26 before it rolls back over. Now, one of the things you can see here, let me point out something. Let me just put a box here. This gap is right here. And gaps are places where the market likes to return to before reversing, because these are extremes, you know, but you can, the other thing I want to point out is right around this gap, you've got a lot of overhead resistance here, a lot of price action above here. So, you know, this is likely to be some sort of resistance area around 26. So if that's the case, we're going to see a pretty good run in silver, you know, from 14, what is it? I don't know, 1450 all the way up to $26. So that, and it should probably take a couple of years to get there, but or maybe just a year. Sometimes the C wave can move really fast. But if you want to own some physical silver, you know, I keep saying this, it's probably not a bad time to look at that. So just keep that in mind. I think I've mentioned this many times. I think silver will ultimately go lower, maybe as low as $7 an ounce. But depending on what's causing this, what caused us to run up the way it did and run down the way it did, some have speculated that it's because more futures contracts were sold than actually silver exists in the world. So if that's the case, then you've got some sort of deflation happening here to rebalance, you know, the paper market with what the physical world supply of silver is. And I don't know if that's true or not, but it sounds like a good reason. So, but if that's the case, it may be that once silver goes to $7, there may physically not be any silver around to buy. Or if there is, you have to buy it at a very high premium and a very high commission, something like that. So just keep that in mind. Oil has made a very strong run up here. It looked like it had topped back here, but it made a run down and run back up. So you can also see here, if I draw in a box here, kind of like I did on the last chart, let's draw it right below all this price action here. See, we're right in an area where there's a lot of resistance because of all this price action in this area. So we could see oil turn here, but this does look very kind of A, B, C, C-ish. So, you know, we'll at least see oil down into this area, which is back down around $40. But that may just be the first move. So you may get a move down to here, kind of an ABC up, and then another move down. But ultimately, my feeling is we'll make again, when gold starts going down and silver starts going down, you're going to see oil do the same thing. Now, it could be that we're going to see some sort of triangle in oil. So this is A, maybe a B to like somewhere in here, maybe right here, and then C into here, and then D. Whoops. Then D, and then E, and then 5. For C down into here, down below here somewhere. Maybe around $20, $18, something like that. So you can see where this formation might be something like a triangle, which is a consolidation move, which makes a lot of sense if you think about it. If gold's going to rally, and gold rallies for a year and a half, well, oil's got to be doing something. Even if it can't rally, it's got to be trading sideways. And so the direction of the trend is here. So when you get a sideways move like this after the direction of the main direction of the trend, you usually get one more leg down before it rallies. So just keep that in mind. I have no idea if that's what's going to play out. It's just, if you look at the timing, here gold's about to take off. It doesn't make a lot of sense that oil would go in the opposite direction. But sometimes it happens, and in order for these markets to align properly, sometimes you get a sideways pattern in one market so that another market can catch up or whatever. This happens all the time. All right, let's look at the euro. The euro is something I've been trading recently. Really like trading the euro. Euro also could be so if you think about the same kind of scenario, you have this run up, and you see this run up started in 2017 and has really lasted a whole year. Well, but look at the move down. The move down in the euro has really only lasted since first part of February to now. So that's only about 6 months. So it could be that, this move down is fine, but this move to correct it has only been 1, 2, 3, 4, 5, 6, 7, 8 weeks. And it just doesn't seem like this has been long enough to correct this move down. I hope you're following me on that. I'm kind of jumping around, kind of thinking in my head as I'm speaking, but this move right here took a whole year. And this is only 1, 2, 3, 4, 5, 6, 7, 8 weeks. So this part right here is only 8 weeks. So it just seems kind of short for a correction. So what we might see in the euro. Let me zoom back out. I got to get more screen here. We might very well see some sort of. Let me zoom in. Some sort of sideways or triangle pattern where this looks like kind of like this. So this comes down. It goes back up, comes down, goes back up, and then down for like a wave 3. So this could be like a 2, but it's this crazy kind of triangle consolidation 2, maybe. Again, we don't know. It's just it's good to have some sort of idea of what you think is going to happen so that you can anticipate where you want to get short or where you want to get long. If you have no thesis at all, then you're just kind of swinging in the wind. Let's see, the British pound, US dollar. To me, this looks like a big correction all the way to here. So if you look at it in that context, you had this move off the lows, kind of a 1, 2, 3, 4, 5, 4, 5. So we could be getting a pullback again. This lasted, almost a whole year. So the pullback, could be A, B, C, and maybe a pullback into here. We could see that sometime next year. And so the next leg up, the British pound should be pretty big. Again, a lot of people look at this and they think, oh, the British pound's going to sell off. It's going to go lower. The problem is this looks like an ABC now. I mean, I don't see really a fourth wave happening here, and so therefore it could be over. It could be over. This could be A, B, C, and now we're looking for 1, 2, 3. All the way up to here, 4, and then 5. So you can see the British pound get really strong. And like I said, probably as a result of Brexit. Europe, the European Union has got Italy and Spain in it. I mean, these are horrible countries. They've got so much debt. I mean, the only country that has more debt than Spain and Italy is the United States. So, and I think our ability to buoy that, at least so far, is just due to the fact that we have the reserve currency. So, when countries always need dollars because they have to buy oil in dollars and they can buy U.S. treasuries with dollars. So there's always a way for dollars to get spent. So there's, the world economy can absorb dollars easier than, say, Europe can absorb euros. I mean, people outside of Europe don't need euros as much as the people inside Europe, whereas the United States has the advantage that the whole world uses dollars. But that day is coming to an end. It's going to be a huge impact on our standard of living. So anyway, I promised you a couple of charts from Elliott Wave. Here's one of them that I wanted to show you. This is the Goldman Sachs bear market model. And what they do is they look at U.S. unemployment rate, ISM manufacturing index, yield curve, inflation rate, and S&P PE ratio, and they look at the possibility of bear market. So you can see here back in 2000, or wait, sorry. Yeah, here's 2000. So you can see here in 2000, the model was pretty high. And of course, we rolled over, we had a bear market. And you can see here, it was high again, right here. And of course, we rolled over, had the financial crisis. But you can see now we're higher. We're higher now than we were at either the peak or the top of the financial crisis. So, some people are talking truthfully, right? They're talking about how debt, now dollar-denominated U.S. debt or dollar-denominated debt in the world is like $70 trillion. And so the world has a lot of debt, and basically they extrapolate these lines to the sky and say, well, if we were able to service the debt back here, then we ought to be able to service it here, we ought to be able to service it here, and so on and so forth. And the problem is servicing debt is going to become more and more difficult as U.S. yields spike higher. So that's the conundrum. All right. Let's show you Dineric's chart. Dineric's chart has us coming into a low back here in February of this year. So February we made that really drastic sell-off, which just turned out to be of an A, B, C, D, E triangle. And you can see here we broke out. So let's look at that a little bit. So we broke out of the triangle here with a big old 1, and then we had a flat you know, with an A, B, C, and then you can see 3, we broke out, and 3, let's see here, doing something wrong. There we go. So you can see 3 ran all the way up to here, and then the bigger 3 ran all the way to here. And he's saying, you know, 4 and maybe 5 is over, you know. Or he's saying, or, you know, this could be an A, B, C with 4 coming down into here, and then we get a 5. That's the thing, when these 4s start to extend, you know, here's a 4, 5, 4, 5. I mean, when this starts to happen, it can, depending on the number of degrees of trend, it can go on for quite a while. So it's hard to, that's what it makes it so hard to pick a top, is you could get 3 or 4 degrees of trend of 4, 5, 4, 5, 4, 5, 4, 5, you know, so on and so forth. All right, what else was I going to show you? Was I going to show you something on, see, Elliott Wave? Oh, I was going to show you the short-term report. So this is the S&P 500 today. Today is October 1st. So, you know, Elliott Wave was able to count 5 ways down, 1, 2, 3, 4, 5. And then they showed this kind of A to here, and then an A, B, C, D, E for a B, and then C up. And you can see it sold off. I mean, it ran up. These are deep retracements. I mean, normally you don't see 0.786, and it may be that this is not the top yet, but it looks pretty good. I mean, we got a good 5-wave move down. We've got a triangle consolidation before a breakout, but it's going to take some, you know, as Gary Kaltbaum says, it's going to, a few more cards have to come out of the deck before we can really say what's going on here. Let's see if there's anything else that I wanted to show you. That just talks about overvaluation of stocks. Oh, here's a gold chart, which is interesting. So you can see he's got gold maybe bottoming here, or it rallies a little bit and then makes a lower low for a C, which is, it's possible, and then you've got this last move up for a C. So we'll just have to wait and see, no pun intended. But just anywhere in here would be a great place to buy silver. Some of the articles I've read is it's going to go to $50, $60 an ounce. Well, you know, if you buy it at $7 an ounce, even with the commissions, you're going to have a good store value there. So, all right, let's go back to our charts. Let's see if there's anything else. We looked at oil. We didn't look at some of these other currencies, but that's okay. We looked at the ES, we looked at gold, we looked at silver. So really, that's about it, everybody. I just, you know, thank you for coming in. You know, look at the euro. Do some trading on that. I think that's a great place to find some opportunity. I can show you a trade that I did. Now I left some money on the table, unfortunately. So I did this trade last week, and you can see where I entered was right here where this purple line is. And you know, because I was looking for it to go up here, but I didn't want to try to enter here because, you know, you weren't necessarily going to get that. So I put my entry in here a little lower. Of course, it rolled back initially at first, but then it came down nicely, very impulsively, and I felt like this was looking to be like a 4. So I went ahead and got out right here where this purple line is, and of course you can see I made, you know, almost $600, which is a good trade. But there's a lot of good stuff happening in the euro. In fact, let's go back. Let's just look at the really short-term report on Elliott, and let's go look at the dollar and the euro. What is this? This is the Dow Jones Industrial Average. dollar. Okay, so here's the euro. You can see, you know, he's showing a 1, 2, 3, this triangle 4, and then 1, 5 down for wave 1 of that larger degree, and then you've got kind of an ABC happening that could be at this degree, but maybe not. So we could have this triangle progressing as, you know, an A, B, C, D, E, and then, you know, lower again. Okay, so there's some good looking charts on the euro, the dollar too. I mean, the dollar looks very promising as well. I keep going. How do I get? Oh, the dollar's here. So the US dollar is kind of the opposite of the euro. So, you know, you got Peter Schiff out there, and I love Peter Schiff. He does some great analysis, but I think his big mistake is that, you know, we talked about it here, that this trend goes back to 1789, and Peter's talking about the dollar, you know, collapsing and all that. I just think we're a long way from that. We're probably 20 years away from or at least 10 years away from the dollar collapsing. So I think it's likely that the dollar climbed much higher in another financial crisis. And then once it becomes obvious that, you know, we can't pay the interest on the debt, then the dollar rolls over and starts to collapse. But that could be 4 years from now. So I just think Peter's timing is off, but I love listening to the show, and I think he's super smart. And I don't know, you just can't go wrong. You can't go wrong listening to Peter Schiff. So I challenge you guys to, if you're using podcasts, go look at Peter Schiff. If not, check him out on YouTube. He has just great current events and economic analysis. So with that, I will end this evening's YouTube video. If you have any questions or comments, feel free to put them in there on the YouTube comments section, and we'll address them here next week. All right, everybody, thanks a lot for coming in. We'll talk to you later. Bye-bye.